Hello, a warm welcome to you all to today's class. We'll be looking at the topic, Introduction to IFRS 15. Introduction to IFRS 15. And the topic says Revenue from Contracts with Customers. Revenue from Contracts with Customers. My name is Dr. Obafemi Oyewumi, and I welcome you once again to today's class. We are dealing with IFRS 15, this particular moment, and I believe that you have a lot to learn, a lot to gain, even from today's class. So join me as I just share my page right now, my slide, so that you can all be part of it. Okay. All right, I believe you can see my screen now. All right, so that's what we have. Introduction to IFRS 15, revenues from contracts with customers. So let's just continue to look at what to expect. In this particular class, we're talking about, IFRS 15, revenues from contracts with customers. That's what we are basically looking at. And then we want to know the basic terminologies of IFRS 15, including contracts, customer income, public performance obligations, and revenue. And of course, we're also going to be appreciating the 5 steps to recognizing revenue from contracts with customers. That's basically our, objectives this hour. So when we talk about IFRS, 15, what's the main objective of this particular, topic, or this particular IFRS, the standard? Okay, what's the main objective? The main objective of IFRS 15 is to establish principles to be applied in reporting useful information to users of financial statements about the nature, the amount, the timing, and uncertainty of revenue and cash flows. That's basically the objective. And of course, we're talking about revenue and cash flow arising from contracts with customers, thereby promoting consistency and comparability across industries and capital, market. That's the main objective of IFRS 15. All right. So let's talk about, let's look at the background to this particular standard. Now, IFRS 15, revenue from contracts with customers, was issued on 28th day of May 2014, and it replaces IAS 18 revenue, IAS 11 construction contracts, IFRS 13 customer loyalty programs, IFRS 15 agreements for construction of real estates, and IFRS 18 transfer of assets from customers, and SIC 31 revenue. That talks about the barter transaction involving, advertising services. Okay, so these previous revenue standards have had, been in the past. Okay, and there have been a lot of difficulties in applying these different, IASs. International accounting standards. Okay, those are the ones that have been replaced now, by IFRS 15. Okay, so initially there have been a lot of different principles that were applied, and sometimes they are very difficult to understand. And of course, because you have multiple standards, so what IFRS has done is to compress. IFRS 15 has done is to compress and bring everything together into one standard, so that there will be no divergent views, opinions, and principles about how to recognize revenue relating to contracts with customers. So that's why we have IFRS 15, and we're talking about today. The 30 date for its operation, okay, its application was January 1st, 2018. So let's look at the essence of this entire, standards. The whole essence of it is revenue recognition. Revenue recognition arising from transfer of promised goods or service to customers by a vendor at a consideration which the vendor is entitled to in exchange for those goods and services. So we're talking about revenue recognition arising from contracts, arising from transfer of goods and services to customers, at a particular consideration. And the core principle basically is just to show how to recognize revenue and to demonstrate that revenue can only be recognized after the transfer of the promised goods and services to the customers. Okay, that's basically what we're referring to, and we're talking about, this particular moment. Revenue will only be recognized by a vendor when an or as control over the goods or services is transferred to the customer. So revenue will only be recognized when there's a transfer. When transfer means control, when the control has been given, a transfer over to the the customer. That's when you are only permitted to recognize revenue. Let's look at the basic terminologies. Basic terminologies, in this particular standards. What are the basic terminologies? Number one, contracts. Contracts is an agreement between two or more parties that create enforceable rights and obligations. So what does that mean? It means that as much as possible, a contract can only be in existence when there are rights and obligations that are emanating from the contracts. And those rights and obligations are enforceable in a court of law. That's a contract. Who is a customer? A customer is someone or a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. So if a particular company is producing a particular product, and another party, a customer now has contracted, for this, the organization or the entities to supply, the things that is being produced. That's the output of that particular entity in the ordinary, talking about the entity's ordinary activities. Then it means that you can say that is a customer. That is someone who is qualified to be called a customer. What is an income? An income is the increase in economic benefits during an accounting period in the form of inflows or enhancement of assets or decrease of liabilities that increase equity other than those relating to contributions from equity participants. So anything that increases the economic benefit, or that increases the asset, or that enhances the asset, or decreases liability other than equity, then that is what an income is. Let's look at another terminology, and it is related to what is called performance obligation. What's a performance obligation? A performance obligation is a promise in a contract with a customer to transfer to the customer either one, a good or service. Two, a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. So when we talk about performance obligation, we're saying that it could either be a good, a service, or a bundle of it that is distinct, okay, or a series of distinct goods and services that are substantially the same. So revenue basically is income arising in the course of an entity's ordinary activities. That's what a revenue, is all about. Let's look at the model. Okay, let's look at the model for the model that IFRS 15, has put in place or has been recommended for, us to, apply. Number one, we have 5 steps. So when we talk about IFRS 15, it talks about 5, model 5 steps of revenue, recognition, basically. So what are the steps that must be taken, for you to recognize eventually your revenue? All right. Number one, the first step is to identify the contracts with the customer. Identify the contract or contracts with the customer. Number two, to identify the performance obligations in the contract. Identify the performance obligations in the contract. We're going to be talking about this, in detail much more, okay, later. So let's look at the third one. The third one talks about determine the transaction price. Determine the transaction price. That's the third one. And then the fourth one, the fourth step, is allocate the transaction price. Allocate the transaction price. And then the final one, which is the last step, okay, talks about recognize revenue when a performance obligation is satisfied. when a performance obligation is satisfied. So from the very beginning to the step 1 to step 5, these are things that must be done before you can say you want to recognize, your revenue. All right. Identify the contract, identify performance obligations, determine the transaction price, allocate transaction price, and then recognize the revenue when the obligation is satisfied. Let's look at the first one. Now we're looking at, each step now in detail. Let's look at this, the first step. The first step is identify the contract with a customer. So the first step is to identify the contract with the customer. All right. So whichever form is coming, a contract in this context, in the context of IFRS, you must know a contract in the context of FIRS is an agreement between parties that creates enforceable rights and obligations. We said that before. All right. That's what a contract is. And a contract can either be written or not written. Okay. It could be, written or not written. All right. But of course, at the end of the day, there must be an enforceable right or obligation that have been generated or that's coming to term based on this particular, term. And that has to do with the fact that a contract, may not be limited, again, to goods or services. Of course, it must be explicitly mentioned in the contract. So let's look at other things that we have to know. A contract with a customer will fall within the scope of IFRS, okay, if all of these criteria are met. When all these criteria are met, okay? Number 1, the contract must be approved by the parties who are committed to performing their contractual obligations. All right, so the first, criterion. Okay, the first criterion here is that the parties must approve the contract. They must come together and say, okay, what are you supplying to me? This is what I want you to supply to me. These are the terms. These are the things that you must do. So the two of you must agree, and then there must be an append. Somebody must append to say, okay, yes, I agree to this, and both of you are signing. Okay, so the major thing here is that the two contracting parties now must have that intention that will bind them together to the terms and the conditions of the contract. That's when a contract, is approved. Number 2, the rights of each party to the contract can be identified. So what are the rights of the customer? What are the rights of the vendor? So an entity must be able to identify its rights as well as rights of all other parties to the contract. An entity cannot assess the transfer, okay, of goods or services if it cannot identify each party's right regarding those goods. So every party that comes to the table must have a right, and it must be recognized. So it must be well identified. Okay, let's look at the fourth one. The fourth, criterion. What's the fourth one? The payment terms of the contract have been identified. Again, so what are the payment terms? It must be identified. They must be known. Okay, an entity must be able to identify the payment terms for the promised goods and services within the contract. So if it is not known, then there is no contract. There must be contractual terms, and then these contractual terms, especially that has to do with payment, must be identified. How is this service going to be paid for? How is this good going to be paid for? It must be, and they must be identified. Number 5 is that the contract has commercial substance. It has commercial, substance, and a contract, that has commercial substance is such that, the risk and the timing and the amount of the entity, it has been well determined. So there must be risk, timing, and amount attached, to it. It must have, commercial substance. Okay, cash flow that's expected to change in whichever form, it must be well, stated. So it is important that anyone that is going, that want to be part of this party, that must have, the contract must have a commercial substance that everybody must agree to. Okay, it must have commercial relevance. So it's not just anything personal. It's not between husband and wife, just like that. No, it must have a commercial, substance. That's what we're talking about here. And so that means that there must be economic consequences. When somebody is supplying the goods, somebody is paying for it. All right. So that's talking about commercial, substance. Then the last one is that the probability of collecting a substantial part of the consideration is high. What's consideration here? The amount that you're going to exchange for the goods or service that you're going to get. Okay, the amount that you're going to exchange for the good or for the service that you're going to get. So there must be a probability that you are going to collect a substantial part of the consideration. This is called collectability assessment. Basically, collectability assessment. An entity must be able to determine that it is probable that it will collect substantially all of the consideration to which it will be entitled under the contract in exchange for goods or services that will to transfer to the customer. So there must be that high probability that the contract will see, the light of the day, and then the amount that are going to be exchanged will be, well noted. And then, of course, the probability of collecting it will be very high. So let's look at this very important note. Okay, let's look at it. If the arrangement does not meet the 5 criteria for recognizing a contract, an accounting contract does not exist, even though a legal contract may exist. So even if there's a legal contract on paper and all these arrangements, okay, are not there, then that means that something is not correct and it will not stand under IFRS 15 as a contract, not be recognized as a contract. Let's look at this particular illustration. Follow, please. Let's look at this illustration. Okay, company, I use the word COI. Company ABC has a customer, that's company XYZ, which is undergoing restructuring due to issues relating to liquidity. Company ABC has decided not to do any further business with company XYZ. In response, company XYZ informed company ABC that it will get a letter of credit from a nationalized bank against which company ABC can dispatch goods worth $15,000. Company ABC has already manufactured the goods exclusively for company XYZ, but the letter of credit has not been finalized. It's yet to be finalized. So when should company ABC recognize the revenue in this particular matter? All right. So we have to look at all the requirements for a contract to be established. Have they been met? If not, then we cannot say that it's a contract. Okay, that's what this particular is just telling us. So let's look at the analysis. Let's go to the next slide and then see what we will come out of this. IFRS 15 requires that a contractual relationship, that for a contractual relationship to be recognized, it should be probable that an entity will collect the money it is entitled to in exchange for the goods or services that will be transferred to the customer. If you look at one of the requirements, that we talked about earlier, okay, we said that the last one, the probability of collecting a substantial part of the consideration is high. In this case now, there's a challenge. In the case that we are looking at, okay, it says that they'll be having liquidity issue. And because there's a liquidity issue, there's a doubt for the amount of this 15,000 to be collected. So what does that mean? Okay, what does that mean? It means that FIRS is saying, hey, this particular thing has not been met. This condition has not been met. And then it says that if a contract with the customer does not meet the initial criteria in IFRS 15 for identified contract with customer that are within the scope of the standard, an entity must continue to only assess the contract to determine whether the criteria are subsequently met. So in this case now, it cannot be said that a contract exists between the two of them. That's the two companies, the two entities. All right. So if the initial criteria has not been met, then definitely we have to put it aside. No matter, no matter the what has been signed, that's been put or set, aside. Okay, they have to be set aside in this particular one. Let's look at another practical illustration. Okay, on the 1st of April 2024, Big Boss Limited agrees to sell 1,000 endoscopy machines. Endoscopy machines to Small Boss Limited. which are produced using a prefabricated tool supplied by another vendor. The payment terms between Big Boss Limited and Small Boss Limited have not been decided, as they are dependent on the price of the prefabricated tool, which is yet to be finalized. Big Boss was paid a non-refundable amount of 4,500 How should Big Boss Limited account for this transaction under IFRS 15 if Big Boss was the principal or in this transaction? Okay, in this transaction, let me just let me go back. Just pardon me. Let me go back to my. Let me go back quickly. Pardon me. Okay, I wanted to correct the one or two errors here earlier on. Okay, machines and then the small boss, so that it is clear for okay, done. All right, so to sell endoscopy machines to small boss, which are produced using prefabricated tool supplied by another vendor. The payment terms between Big Boss and Small Boss Limited have not been decided, as they are dependent on the price of the prefabricated tool, which is yet to be finalized. Big Boss Limited was paid a non-refundable amount of $4,005. Now, ordinarily, one would have probably thought that, okay, having committed, themselves to the payment of $4,500, then that means that the contract has been established and it's ready for execution. But then, what is the view of IFRS 15 in this particular one? Okay, we have to take note of some basic factors. If you look at it here, the payment terms have not been identified. What are the payment terms here? So I want you to begin to reason and look at it vis-a-vis what we discussed earlier on. What are the payment terms in this particular, this particular contract? If you look at one thing that's written there, okay, it says that the payment terms between Big Boss Limited and Small Boss Limited have not been decided, so no payment terms. So it contravenes one of the conditions, okay, that should be met before a contract is established under IFRS. Okay, so the 4,005 that have been paid, what does that mean? Should it be taken as income? No, it shouldn't be taken as an income. So it stands as a liability. It stays there as a liability in the account of Big Boss Limited, because it will not be used to satisfy the amount, okay, or maybe to say a part payment for the contractual figure or the fee. So in this case now, there is no contract that will be recognized by, Big Boss Limited under IFRS, 15. Okay, that's what it basically means. Okay, that's what it means. Non-refundable amount of 4,005 further paid to Big Boss Limited must be accounted for as liability by Big Boss Limited. So Big Boss will continue to account for the non-refundable as well as future payment as a liability until the criteria for identifying a contract with customer within the scope of this standard, okay, are met. Until then there is no contract. It will just be taken as a liability. I believe that somebody is getting to learn one or two things here. Let's go to second point, and that's identify the performance obligation. What is the performance obligation? We have defined that earlier on. Remember, a performance obligation, for the purpose of clarity, is a distinct promise to transfer specific goods or services, distinct from other goods or services. A performance obligation is a distinct promise to transfer specific goods or services that are quite distinct from others. Okay, that's what you have to know. It must be performed. It's an obligation that must be performed. That's why it's called performance obligation. That's why they call performance obligations. Okay, so here we talk about a good or service, or a bundle of goods or service that is distinct, or a series of goods or services that are substantially the same and that have the same pattern of transfer to the customer. That's a performance obligation. Okay, that's a performance obligation. We're talking about the good or service that is distinct. Okay, for it to be distinct, let's look at the following criteria. Let's look at the following criteria rather that we must look, we must consider for you to say that this good or service is distinct. Number one, the customer can benefit from the good or service on its own or together with other ones that are readily available, to the customer. Number two, the entity's promise to transfer the goods or services to the customer is separately identifiable from, other promises in the contract. Okay, look at the first one. Said the customer can benefit from the good or service. We are talking about a good or service is distinct. Can only be distinct when the customer can benefit from the good or service on his own. Okay, or when they join with other resources. Okay, number two, the entity's promise to transfer the good or service to the customer. Okay, and must be separately identifiable from other promises. It is separable from other obligations in the contract. So it must be well defined and it must have, the capacity to be separated from other obligations, in the contract. So that's talking about, we're looking at the criteria. Okay, we're looking at the criteria here. What will make a performance, what will make a good or service to be distinct from others? So let's look at this illustration. Let's look at this illustration. ABC Limited enters a contract with a customer to supply a license for a standard software product. ABC Limited will also install the software, provide updates to the software and technical support for how many years? For 5 years. For 5 years. Okay. ABC sees the license and technical support separately. The software will continue to operate without the software updates, and ABC Limited subcontracts the installation of the software to several approved installers throughout the country. Now, let's analyze this. Let's analyze this properly. ABC has entered into a contract with a customer to supply what? License. Okay? For a standard software. And ABC Limited will also install software. Install the software. We also install the software so that it's installation and provide updates to the software that will be updating that will be needed to be done, which will be provided by ABC. And then there will also be technical support for how many years? For 5 years. So look at this scenario. That means that all this could be broken down into different segments, into different compartments. So when we talk about performance obligation, we are compartmentalizing them. We're trying to break them down. We're trying to, classify them to distinct, elements. That's when we talk about performance obligation. So let's look at the different scenarios being placed here, and then let us look at the different, distinct goods. So given the above information, we can analyze the scenario as follows. The customer can benefit from each of the goods or services, either on their own or all together. The promise to transfer the goods or service means that they can be separately identified. And so consequently, there are several distinct goods or services in this particular contract. Number one, the software license. Of course, you know that for you to use software that has been developed by whoever, it means that you must have a license. So software license is number one. Number two, there must also be installation. So when you get a license, somebody is installing, the company is installing. So that's another service. All right. Then we talk about software updates. That's another, distinct assignment, a distinct performance. And then the technical support for 5 years. This is a distinct one as well. So it means that that particular contract, have distinctive features, and they could actually be, separated from from another, differentiated from one, from the other. So that's talking about, the performance obligations in this particular contract. You can see that, yes, one contract, but there are different, performance obligations. Number three, let's look at the third one. We're looking at, the steps that IFRS 15 has recommended for you to talk about, recognition of revenue at the end of the day. Determination of the transaction price. That is the third step. That's the third step. So the transaction price is the amount of consideration to which the entity expects to be entitled in exchange for transferring the promised goods or services to the customer, excluding amounts collected on behalf of third parties. For example, say stars. We talk about VAT or whatever. So that is not part of the transaction price. We're talking about the price that the customer or the vendor is going to charge the amount of consideration, okay, that the entity is entitled to collect, that the entity is entitled to get in exchange for transferring the promised goods and services to the customer. That is the transaction price. What are the various factors that will help to determine this? Number one is the terms of the contract. So you look at the terms of the contract, you'll be able to see it there. Past customary business practices when making this determination, okay? And then factors such as returns, bonuses, discounts, rebates, available fact considerations play a pivotal role in this calculation. Okay, so you must pay attention to this because it's very, very important. The transaction, price. Okay, these are factors that you must consider. So let's continue. All right, transaction price could be fixed, or a fixed amount, a variable amount, or in a form other than cash. Other than cash. So that's transaction price. It's either fixed amount, variable amount, or in a form that's other than even cash. If the consideration is variable, now there are some technicalities involved in this. If the consideration is variable, the entity must estimate the amount of consideration to which the entity is entitled, in exchange for transferring the promised goods or services to a customer. So we have some instances where consideration, the amount they are going to pay, maybe a little bit different from what it varies. That's what we're talking about variation. Okay, there could be variation here. And what is this variation? For example, if there's discount, along the line, if you supply 1,000, you're going to pay 500 naira, for example. But if you supply 1,005, you buy 1,005, okay, the amount of money will reduce to 480 naira. So that's a discount. So it becomes variable at a particular point. So it's not going to get fixed. All right. So it's possible for a contract to be like that. So all of this must be put to consideration. That's what we're talking about here. So the amount of consideration can vary due to discount, the last part here, due to discount, rebates, refunds, credits, price concessions, incentives, performance bonuses, penalties, or other similar items. So there are reasons where one way or another could be a variation. There are reasons, and these are the reasons I know have been itemized, there. All right. Again, what are the reasons why what could also account for consideration to be varied? Okay, the promised consideration can also vary if an entity's entitlement to the consideration is contingent on the occurrence or non-occurrence of a future event. Is possible. The occurrence or non-occurrence of a future event. It could be like, okay, please enlarge your store. Of course, there will be financial considerations relating to such. The transaction price may be adjusted for the effect of order, or for the effect of the time value of money. If the contract includes a significant financing component, it's possible for there to be a financing component. So, okay, I'm going to supply 4,000 worth of this particular 4,000 units of this particular product to you, but then you don't have to pay me, until a particular period. That means that I'm supplying as a cost that I'm bearing. So definitely there will be time value of money, because when you are paying me back, or when you are paying the entity, the money, that it's expected that you're going to pay more because of the time value of money. All right, the time value of money. So let's look at some illustrations as we just dwell on this as much as possible. One says that ABC Limited enters into a contract with XYZ to sell its product for 200 naira per unit for the year 2017. If XYZ purchases more than 1,000 units in the year, the price will decrease to 150. Look at this scenario now. I'm going to supply the cost of the product is 200. But then if you're going to buy more than this amount, then the price will come down to 150. ABC Limited does not believe at the date of the contract, the date the contract was initiated, that XYZ will purchase more than 1,002 from it. You know, and look at the reasons here. Due to past trading patterns with the customer. But on 30th June 2017, XYZ bought 600 units and another 500 units on 1st of October 2017. ABC now believes, okay, that XYZ could meet the target based on its sales of 1,100 units, you know, in the kitty already as at that date. On November 1st, 01 November 2017, XYZ informed management of ABC that it will be placing a further order of 200 units on December 2017. How should ABC Limited account for its sales to the customer for the period 2017 or for the year 2017? You can look at the different scenarios there. Okay, initially, I'm going to sell this product to you. ABC says, I'm going to say that I'm going to sell this product to you at the rate of 200. Believing that this particular company, XYZ, will not be able to buy more than 1,002. So the contract came with a caveat. If you buy more than 1,002 in a year, I'm going to reduce the amount to, you know, to 150. Okay, to 150. In June, XYZ bought 600. And in October, bought 500. How many? Okay, do we have here? We talk about 1,001. So it has reached 1,001. It remains just 100 to break through. All right. And then he came back to say, I am going to sell this other one. I'm coming to buy more, 200 units on the first day of December. So let's look at what this will amount to in the records of ABC. In the records of ABC, I believe it's possible for you to see. So based on the fact that ABC Limited does not believe the customer will achieve the target, it should account for the sales. So that's a blanket, you know, accounting at the very beginning, a global picture. The global picture, you know, at the beginning, excuse me, was 600 times 200. I'm going to collect, the ABC thought that you collect 120,000 naira from this particular entity. So the journal entries will be to debit receivables 120,000 and credit revenue 120,000. Okay, but now in June, I haven't realized that this particular organization, you know, who came back to buy 500 units. This time around, he knew that this customer will reach his target. So what did he do? He didn't price 500 units. 500 units will no longer be priced at the rate of 200. It will be priced at the rate of 150. So that brings us to trade receivables of 75 and then revenue of 75. And then the following in October, when he came back again to buy 200 units, okay, when they came back to buy 200 units, all right, that would be in December right now, order of 200 units. So trade receivables will be 30,000 and then revenue of 30,000. But then there should now be an adjustment because they recognize initial 600 at the rate of 200. So there should be an adjustment to the amount. There should be an adjustment. And we look at this one. Say the calculating the sales value of the original 600 sold in the first 6 months at the rate of 200. What must now be done? There must be an adjustment. Adjust your revenue, adjust your credit receivables, because that particular amount of money this time around, okay, is no longer tenable. It must be refunded. I mean, it must be your system, the accounts of the account must be adjusted to reflect the 150 naira per unit, because this man or this particular entity XYZ has been able to satisfy the conditions of the contract. Okay, so what should be done? There's a difference between the original price of 200 and 150. That's after the discount. Okay, so 50 naira difference will now be used okay, to multiply the 600 that was initially sold, or the 600 unit that was actually initially, entered into the records of the company. There will now be an adjustment by debiting what's 50 multiplied by 600. You get 30,000. So you now have to debit your revenue, okay, to adjust this debit revenue by 60,000, and then credit trade receivables by 30,000. That is how to treat this particular, transaction. The way to do based on IFRS 15. Okay. Now let's look at the fourth step. What's the fourth step? Fourth step: allocate the transaction price. Allocate the transaction price. That's the fourth step. This is the distribution of the transaction price to the identified performance obligations based on their standalone selling prices of each distinct good or service promised in the contract. Okay, so it's possible now. We're talking about the different performance obligations. If you look at the one that we talked about initially, okay, the one that we referred to initially, our example when we're talking about this, okay, look at this example. We said for one contract, there will be four performance obligations: software license, installation service, software updates, technical support. Now, these are standalone, standalone obligations or standalone products or services, as the case may be. So it's possible for this one to come at a different price. If this organization, the customer, if the customer wanted to buy, the software license alone, nobody will stop the customer. So you buy the customer, you buy the software license. Maybe you wanted to limit it to, maybe if you wanted to limit to installation alone, and don't bother himself with software updates or technical. It's also possible. Software updates, it's also possible to use another vendor entirely, okay, or to get technical support for another vendor, entirely. But in this case, we're talking about the same vendor and then the same contract. So this time around, we're talking about how do you allocate the price to all these unique and different and distinct, goods or services. How do you allocate them? So we're saying you are to distribute the transaction price to the identified performance obligations based on their standalone selling prices of each distinct good or service promised in the contract. Where a contract has many performance obligations, an entity shall allocate the transaction price to the performance obligations in the contract by reference to their relative standalone selling prices. Is that clear? I believe somebody is taking note of this. So an entity is permitted shall allocate the transaction price to each performance obligation in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for transferring the promised goods or services to the customer. Okay, let's look at this, exercise. Look at this illustration. Okay, a software company sells a bundle that includes both a software license with a 12-month support service for a total price of 1,200 or 1,200,000. Now, if sold separately, the software license will cost 1 million, and then the support service 300,000. So meaning that in this particular scenario, there are two distinct obligations. One, the license. Two, the support service. So there's a contract here. There have been, there's a customer, there is a vendor. Okay, the terms have been stated. It is known, and then the standalone prices we also know for the distinct, services, or the distinct good and service. So there's a good here and then a service along the line. How will you allocate the transaction? Allocate the transaction price. Now let's look at how this will be done. Let's look at the solution. Okay, the first thing you have to do, calculate the total standalone selling prices One will cost 1 million, another one will cost 300. So the total will be 1,300,000. Determine the allocation ratio for the software. So how do you determine the allocation ratio? Is by using the cost, the standalone price over the total amount of the standalone, price for the two items. Okay, that's what you have. And then by the time you do that, you arrive at 76.92%. You'll do the same thing for the support service. You get 23.08%. Now, how do you now allocate the transaction price? Is to use the percentage that you have derived, okay, to multiply, to multiply, the amount that you are paying. You can see that in this particular case, a discount of 100,000, have been made available. Okay, be made available. So here we have a discount of 100,000 that will not be recognized, although there is a cost attached to it, but in this case now there's a discount. So what do? You now have to use the ratio for software to get the amount to recognize for the software. So in this case now, you'll be recognizing 922,400 naira, 922,400 naira as the price for software, and then 277,600 as the price of the support, service. Okay, the support service. So that's what is expected, that should be done. So in this case now, the company has recognized the revenue for each component based on its relative standalone selling price. Let's look at second illustration. The second illustration along the line here. A retailer sells a customer a package consisting of a computer and a printer for 700,000. Now, that's the two. The retailer realizes that there are two separate performance obligations involved. It regularly sells the computer for 500 and printer for 300,000. What is the total amount? Total amount of money should ordinarily, if they were to be bought separately, it will be what? 800,000. But because the customer is coming to buy the two, so he gave out, or is giving the price, is giving the customer 700,000. 700,000. So how do you allocate 700,000 to the two, obligations? One, the supply of the computer, and then two, the supply of the printer. Okay, so let's look at it here. The transaction price is what? 700,000. Standalone price is 500 plus 300. That's 2,000. So you're going to arrive or derive, the what now? Derive the a ratio, that'll be proportionate to the price of the computer and, the printer. As they multiply by what? By the amount of money that's been considered for this particular, transaction. So you have 437, it's naira, please. 437,500, and then the other one is 262,500. Okay, so we have an inherent discount of 100,000, in this case, which does not relate to specific performance obligation. Therefore, it's allocated. So that means that every item here will benefit from the discount. Okay, every item will benefit from the discount. Let's go to the last step. The last step is recognize revenue. Recognize revenue when performance obligation is satisfied. We have been talking about, basically, you can see that all the steps are leading towards revenue recognition, basically. So having satisfied the performance obligation, then we can now recognize the revenue. Revenue recognition here is to be done when control is passed. When control is passed, okay, the control over the asset is passed to the customer. Okay, control of an asset means having the ability to direct the use of and obtain all the remaining benefit from the asset. So if I go to the market, for example, to buy a particular product, this time I remember the customer, it means that he has the control over the asset. He has the capacity and ability to make use of the asset anyhow he wants to make use of it, and of course to benefit from the asset. That's what this particular place is talking about. So what is control when it comes to IFRS? Maintain a control over an asset means that I have the capacity and I can use it anyhow I want to use it. Okay, and then I can obtain the remaining benefits from the asset anyhow I want to make use of it. Okay, so factors which may indicate that control is passed at the point in time include, but not limited to, the following. Okay, we're going to be talking about recognition of revenue in time and over time, subsequently. All right, factors which may indicate that control is passed at a point in time include, okay, it's already stated here. The principle is based on the point at which the customer obtains control of the good or service. Now, let's go to this. Number one, entity has the present right to payment for the asset. The customer has the legal title to the asset. The entity has transferred physical possession of the asset to the customer. The customer has significant risk and rewards relating to the ownership of the asset, and the customer has accepted the asset. So you have to take note of all of these points because they are very, very germane, very, very important to the understanding of IFRS principle as relates to contract revenue from contracts with customers. Okay, very, very important, very, very important. So please take note. For anybody as a student, please take note. Okay, not just to them, even practitioners. Okay, recognition of revenue can occur at a point in time or over a time frame. A point in time or over a time frame. Please, again, take note of this. So, depending on the nature of the obligation, when we talk about the point in time, we are saying that when there is a transfer of the promised good, when there is a transfer of a particular good, then you can say, or a particular product, based on the contract, you can say this one is point in time. And then over a time frame, it is typically referred to promises of transfer of services. This time around, you are carrying out a service. You are not just delivering a good, but you are carrying out a service. So typically, point in time relates to transfer of goods, and then for overtime, typically relates to transfer of services to customer. So for revenue recognition at the point in time, the following are the indicators that control has been transferred. Okay, so it's just like a repeat of what we have, earlier on that I put here. So a repeat of it. Okay, that's why I talked about the point at the point in time. So let's look at it just for emphasis sake. The entity has the present right of payment for the goods. Customer has received legal title of goods and services. The customer has physical possession. The customer has the significant risks and rewards, okay, related to the ownership of the asset, and the customer has evidence for the customer's acceptance. Okay, the last part of it, is based on recognition of revenue over time. When revenue is recognized over time, it means that revenue is deemed to be recognized to the extent that each of the vendor's performance obligation has been fulfilled. So that means that there is a sequential fulfillment of the obligation. And then revenue will not be recognized until one particular part is concluded. It's when it is fulfilled that you recognize the revenue. So that means that incrementally you keep on recognizing as the performance is being carried out, because it's over time. And that can only happen when a service is being rendered, not when a good is being sold. I believe somebody is getting that. All right. So an entity recognizes revenue over time if one of the following criteria is met. Number one, the customer simultaneously receive and consume the benefit. So there must be a receiving, and then there must be a consumption of the benefit. And that's the service. Number two, the entity's performance creates or enhances an asset that the customer controls as the asset is created. So it's either you enhance the performance. For example, maybe you are repairing, maybe you are servicing a particular generator that you install in a particular organization. You are enhancing the asset, and the customer, of course, has the control over the asset. The entity performance does not create an asset with an alternative use to the entity. So it's that particular asset is being used. So there is no, like, it's not as if you are going to carry the same asset and use it for something else. Okay, and it has an enforceable right to payment for the performance, at the completed date. So when the data is completed, the enforceable right of the payment, the other particular, the vendor has the right to collect, the money that is due to the vendor this time around, to the vendor. So for a performance obligation to be satisfied, for performance obligation satisfied over time, an entity will select an appropriate measure of progress to determine how much revenue should be recognized as the performance obligation is satisfied. So we're talking about sequential satisfaction, okay? On monthly basis, quarterly basis, yearly basis, as the case may be, depending on the contract. The revenue will not be recognized at once. It will only be recognized, sequentially. So even if it means that the customer has paid for a 5-year contract related to services, it means that you can't recognize everything at once. You can only break down, okay? While you recognize a portion, the other portion will be in your what? In your liability. If your liability is more than 1 year, then we talk about long-term liability. If it's within just 1 year, then we talk about the short-term liability. I believe that we have been able to have a good time together, even this particular moment. We've been talking about IFRS 15. Okay, this is the introductory part, basically introduction. Okay, so not the entire gamut of the whole thing, but just the introductory part of it. Talking about the steps, the 5 model, the 5-step model for recognizing revenue as relates to contracts, with customers. That's what we have been relating and discussing. And I believe that you have been able to gain one or two things here relating to today's class. So if you have learned one or two things, why don't you just go ahead and, of course, subscribe to my YouTube channel. And of course, I want to implore that you do that. Like, subscribe, and even share this particular, the video, so that everybody will get to see it again. And of course, when you subscribe, there will be a prompting whenever another video is dropped, because this is just meant for us to improve and to get to know. And that has to do with taxation, that has to do with accounting, that has to do with financial reporting, and that's what I am, into. Okay, so I believe that subsequently you'll be able to hear and see more of this type of, lecture, as the one that's been done, today. So go ahead, subscribe, go ahead, like, go ahead, share this particular, and of course, make comments, so that there are other things that you feel that, yes, you're not too clear about. You can put it there, ask questions, and then when I get the notification, I will also respond accordingly. So thank you very much for being part of the lecture. I believe, once again, that you have learned one or two things. Thank you very, very much. So see you at another time. Thank you.